Welcome back to the Microlearning Institute. In this tutorial we look at IFRS 2 share-based payments, and specifically we look at an example of how to account for a grant of share options that's accounted for by applying the intrinsic value method. Now you will remember from previous studies that we calculated that the cumulative equity to the statement of financial position for an equity settled share-based payment is calculated from the formula on the snapshot there. However, we did say that if the fair value was not readily available, then we use what's called the intrinsic value and we adjust at each reporting date. And again, we're going to see an example of this working in this example. And again, just for definition, the intrinsic value of an option is the difference between the underlying stock's price and the strike price of the option. So for example, if a call option, which is an option to buy a share, if the strike price is $15 and the underlying stock's market price is at $25, then the intrinsic value of the option is $10 because that's the difference between the stock price and the strike price. In this example, we're told that at the beginning of year 1, an entity grants 1,000 share options to each of 50 employees. The share options will vest at the end of year 3, provided the employees remain in service until then. The share options have a life of 10 years, and the exercise price is $60, and the entity's share price is also $60 at the date of grant. At the date of grant, the entity concludes that it cannot estimate reliably the fair value of the share options granted. So here we're given a table of the share price at each year end. So at the end of year 1, the share price goes from 60 at grant date to 63, then further up to 65 at the end of year 2, and further up to 75 at the end of year 3. We're then told that at the end of year 1, 3 employees have ceased employment, and the entity estimates that a further 7 employees will leave during years 2 and 3. Hence, the entity estimates that 80% of the share options will vest. So let's look and see how we account for cumulative equity to the statement of financial position in this scenario. So we see first of all that 80% of the 50 employees are likely to vest. They each are entitled to 1,000 share options. Now the intrinsic value of those options at the end of year 1, given that the strike price is $60 and the share price is $63 at the end of year 1, is $3. Now we're accounting for these using the intrinsic value method, and we also time apportion this equity over the vesting period, and right now the vesting period is estimated at being 3 years. So consequently, from this formula we recognize cumulative equity to the statement of financial position of $40,000 and a corresponding expense to the P&L. Next, we're told that 2 employees leave during year 2, and the entity revises its estimate of the number of share options that it will expect to vest to 86%. So, at the end of year 2, we again can calculate from the formula the cumulative equity to be recognized to the statement of financial position. Now it's 86% of the 50 employees are expected to vest. Each will be entitled to 1,000 share options. Now the intrinsic value now has changed to be the difference between the strike price, which is still 60, and the share price at the end of year 2, which of course we were told in the question is 65. And again, we time apportion the equity over 2 years with respect to the 3-year vesting period. So now the cumulative equity to be recognized to our statement of financial position is $143,333. That's up from $40,000 at the end of year 1. So consequently, we must recognize the incremental $103,333 expense to the income statement. Next, we're told that 2 employees leave during year 3. Hence, 43,000 share options vested at the end of year 3. So now again, we can calculate the cumulative equity at the end of year 3 to be the 43,000 share options multiplied by, now again you can see that the intrinsic value, because the share price has gone to $75 at the end of year 3, the intrinsic value is now the difference between 60 and 75, which is $15. And again, we recognize all of the equity now. We time apportion it over the vesting period, so we have cumulative equity of $645,000. $147,000, up from $143,000 the previous year, so we need to recognize, as usual, the incremental expense to the P&L. Next, we're told that the number of share options exercised during years 4 to 10 are as follows, and we present a table shortly. And share options that were exercised during a particular year were all exercised at the end of the year. Okay, so here we go. We're told that in year 4, for example, the share price had gone up to $88, and 6,000 of the share options that we had granted were exercised by our employees, and so on for the remaining life, the 10-year life of the share option arrangement. So for year 4, in order to calculate the cumulative equity, we have to calculate the intrinsic value of the options that were exercised, and of course he tells us in the question that there were 6,000 options exercised, the share price is 88, and incrementally up from what we had recognized to date of 75. So the incremental intrinsic value is the difference between the 75 and 88, and again for 6,000 options. Now we also had outstanding another 37,000 options. Of course we have a total of 43,000 options granted at year end year 3, so if 6,000 are exercised there must be 37,000 outstanding, and again the incremental intrinsic value of those options again is the difference between 88 and 75. So the sum of the two of those calculations gives us the cumulative equity to the statement of financial position of $1.204 million, up from $645,000 at year end year 3. So as usual we recognize an incremental expense to the income statement. In year 5 we see the share price has jumped even further to $100, and a further 8,000 share options were exercised at the end of that year. So again, we had $37,000 outstanding at the end, 37,000 share options outstanding at the end of year 4. If 8,000 were exercised, then 29,000 must still be outstanding at the end of year 5. And now the incremental intrinsic value is the difference between what we had recognized to the end of year 4, i.e. $88, and the share price at the end of year 5, which of course we're told has jumped to $100. So that difference, $100 minus $88 or $12, is the incremental intrinsic value that we must recognize in year 5. So again, when we sum both the outstanding and the exercised options at their intrinsic value, we see a cumulative equity of $1.648 million, up from $1.204 the previous year, and in the normal fashion we recognize the incremental income statement expense of $444,000. Next up, we see that the share price at the end of year 6 has dropped from what it was at the end of year 5 of 100 down to 90. And again we see that the number of share options exercised were 5,000. So similarly, we see that at year end year 5 we had 29,000 share options outstanding. If 5,000 were exercised, then that leaves 24,000 outstanding at the end of year 6. Now, the intrinsic value now is negative because of course we had accounted for a share price up to $100 at the end of year 5, and now the share price has dropped to $90. So now when we calculate our year 6 cumulative equity, it reduces from what it had been at the end of year 5, which was $1.648 million, to $1.358 million. And again, we need to recognize the corresponding credit to our income statement of the difference between the two cumulative equities at year end, and that of course is $290,000. Now, the remaining calculations would be similar, and I won't take the time on this video to do each calculation for years 7, 8, 9 and 10. However, you can look and validate your calculations from the following table, where we can see the income statement expenses at years 7, 8, 9 and 10, and the corresponding cumulative equities for each of those year ends. Thank you very much for watching this short tutorial on IFRS 2 share-based payments from the Micro Learning Institute.